All right. Good morning, everybody. Zoom with these widgets that it keeps installing. Starting to get a little glitchy. Maybe it shouldn't. Anyways, we've got PMI numbers today, and we're going to get a small glimpse of employment numbers today. Google turned out okay, I guess. And maybe it's just depending on the point of view. They increased their capex spending another $10 billion. I mean, what's $10 billion among friends? And now I believe it's over 80 billion at this point is their capex. If we can expect the others to also increase their capex, we know Meta's going to do that, and we can anticipate that Microsoft is going to do that. Very possibly Amazon. Where's the spending go? Right? It's continues to be a part of the fuel that leads this drive higher and uh, reflects why we pay such attention to the Mag 7 hyperscalers. The Dow down more than a quarter, small caps right behind it at a quarter. Hong Kong closer to flat, S&P slightly positive, with the Nasdaq leading the way today. Maybe we should cheer. After 2 days of dragging its feet, it's now turned the corner and is back in its usual position of leadership. Did you like it? You certainly saw yesterday when it started to change. And I put that post out, right? When I seen that the S&P leadership was starting to change and that the Nasdaq was trying to assert dominance. It was right about the turning point yesterday, right? We had that intraday wedge pattern. It's a really great pattern, by the way. When you see this one, um, gotta love it when you get it. But if you had seen the Nasdaq at the same time, we didn't have such a beautiful pattern. This one isn't as clean. It doesn't have that flat top on it, and the three bars that comprise that low nearly had those equal lows. So it's just a really choppy, nasty mess down there. But it was around this expansion when I put the post out, maybe a little sooner, that the NASDAQ was starting to take control of the situation. And then, of course, we saw the outcome from both the ES and the NASDAQ. And it's why we wanted to pay attention to the NASDAQ in the first place and the discrepancy between them and the fact that the ES was leading. So take what we can get, right? You're not seeing my screen? All right. What's with Zoom today? All right, let's try again. See me now? How about now? All right. Well, when I was trying to start the stream, I was fighting with Zoom over this widget, this new widget. I'm going to uninstall that darn thing and just be done with it. Just solve that problem. Well, you could hear me, so that was good enough. I'll show the chart when we get back to the charts. We've got a little bit of job numbers, nothing out of line, at least nothing out of line anticipated. And then we've got PMI, new home sales. We got some auctions today, including the 10-year. I like the 10-year. Pay particular attention to that one. We could get a little info out of the bond investment tonight, but that'll be tonight. It's not really going to be an intraday problem. Whatever Secretary of Treasury did over in Japan really changed their tune, between last week and this week. Hasn't solved that 10-year though. We do have auctions today, so we get to see what's going to come of that. All the all the FX markets yesterday were acting squirrely. But by the afternoon is when things really started to change, right? When we saw the Nasdaq begin to assert that dominance again. And it's back, right? Like we're back into normalcy. We need a name for that, right? We need a phrase. When volatility is acting normal, we call it contango, and when it gets out of line, we've got a name for it. So we need a name for when the Nasdaq is dragging its feet and cedes dominance to the ES. I don't know what we would call it, but if we got contango and backwardation for VIX, we could come up with some strange name for that situation. The pattern that I was talking about for yesterday, that's a really good one, is this. Generally spotted on a 15-minute, but obviously if you know what to look for, you can see it on a 5. I like that. I think we could run with it. Then we just need the other word, right? Gotta have two. So this pattern usually works out really well. And it was right around the time of that push to the upside when I had made the announcement that the NASDAQ was starting to take control again. And I mean, see what we got out of it. It turned out really well. We just had to get that change, right? If we didn't get the change, we weren't going to see this push that we got yesterday afternoon. So now we are, well above the 10-day again, far beyond the 20-day. Any risk from the 4-day at this point is, a bit sidelined. The concern at this point is one of these situations. You get too far away from that 4-day and you end up having a bit of a mean reversion. Same thing happened here. Now, we don't have to fall. Just make that clear. When you're looking for a correction, which is what I'm looking for at this point, because we had that really swift move, corrections can happen in two ways: correction in time or a correction in price. A correction in price is going to look something like this. We will turn around and we will go right back down, having gotten ahead of ourselves and moved too far too fast. Or a correction will be us just going sideways, giving the market time to catch up, which is, say, kind of what happened here. This isn't a great example, but it'll do. We got up there and we just stalled for a couple of days, and we gave time to that line to get caught up with us. So we do kind of need a correction after that move, but we need to sit back and evaluate what kind of correction are we going to get. We don't want to make the assumption that it will be a correction in price. We did see the call wall roll down slightly. It was a very small move. It seemed more of a reaction function just from the way that the machine validates the next spot. We would want it to sit still for a couple days for us to determine that it's in some permanent location due to them positioning it, right? If they go in and trade it heavy and the call wall gets moved to a spot, it's going to stay there for a while. If it's just, say, something falling through the options chain, then it's just going to keep falling through the levels, right? So for an example, it's calculating the notional value here. And if there was a big pool of options on this put wall, or we're actually talking about the call wall. So over here, say this very large call wall level, notional value level, and it just expires today, then tomorrow it's going to find a new home, right? But if there's a larger level farther out in time that eclipses these, and then that call wall stays put for multiple days or even, for a few weeks, then it'll be because they positioned it. The other way that we'll see it sit tight is if they start positioning through multiple expiries. The idea being, that say they want to cover, I don't know, 6,300, 6,400, right? They got a number that they want to cover 65, and that becomes the level that they've covered across 6, 7, 8 days of trading. So that call wall and put wall can shift on a day-to-day basis. And we say the words like, oh, it rolled up or it rolled down, but a lot of the time they didn't do any deliberate active trading to try to make a new level somewhere. The algos just picked up the next notional value position. Running at 53 in the overnight. So the volume's kind of okay. It's within line of what we would expect. If we consider that run into the end of the day, we are now still inside day this morning. We haven't gone anywhere. We didn't get our breakout of yesterday's range. We weren't able to keep it. We've tested it multiple times and just have failed to get there, right? Just think of the suppression tactics. There's an entire zone up here, lots of sellers, and we haven't been able to get through that level. Situations like this usually pan out in one of two ways. They try a couple times to get through that level, and then they give up, right? They don't see rewards for their effort, and they just run it back. The other one is that we continue to test it and we take the liquidity out and there's nothing left, and they have to find sellers higher up. So one or the other, right? If it was them giving up, I would expect a pattern like a 1, 2, 3 fail. And we don't have that. We also want to watch to see how it leaves the zone. This first little dip doesn't really count because it's kind of like, it was part of the open and all of that. The next time we tried it and we sold off a lot more, that's the one that you want to measure, because now we've just tried it again. And we want to compare, if we pull back, how far do we pull back compared to this pullback? If it's a shallow pullback, if we don't, for an example, break this low, then we could anticipate that the pullback is just another run at it. I've talked about the stuck door policy idea, right? That when markets try to get through a significant level and they can't do it, they do what humans do, right? When you come across a sticky door that doesn't want to open, you back up, lower your shoulder, and give a bit of a running start at it, right? So price try to get through, it doesn't, it gets enough room away from that level to make a run at it and try it again. When that one doesn't work, we often see a deeper pullback, or it's a bit of just a test and then a go. So we need to see, now that we've hit it, we need to see what they're going to do with it and whether or not we can actually get through it. Watch for the 1, 2, 3 fail, by the way. We've set that high now. And we've got this really simple, really close low. So those are the two pivots you want to keep your eye on. Break this, we've started our lower lows. Break that, we've got our higher high. Not all that complicated. And the range for the Globex that we started with the initial balance, we didn't get much of a breakout on that initial balance either. So looking at what they've gotten done in the overnight, they didn't get much of anything done. We're still seeing that odd volume that is showing up between, say, 1 and 2. Like this push here, there's nothing there. You know, like it's not Europe. It's nations that haven't been heavily traded in a while due to sanctions and everything else. And we're starting to see more trading activity between 1 and 2, or say between 1 and 3. There's always that kill zone, right? We haven't talked about the kill zone in a long time, but there is the kill zone between 2 and 4 in the morning, oftentimes attributed to, you know, London and the Europe Open at 3, but not just that. So maybe we're starting to get a more consistent kill zone, because for a while we just wasn't getting anything in that kill zone. It's like it I think it was because of the sanctions. Yeah. Either way, if you're trading in the overnight, keep your eye on that time frame. Often get some good opportunities. For us, the focus is the initial balance last night and the lack of effort, or maybe they put in a lot of effort but lack of results. And we want to get out of that candle's range. That would be the 1630. This is the candle of importance, that high and that low. You can measure it with your quad lines, set your 111 off of it, break the mid from it, and that's the level that we have to get out of if we're going to get anything else done today. We're basically flat this morning. We haven't gotten anything done. To get to the upper ADR, we're going to need that inside day breakout, which would be a continuation of yesterday's push. Looking at it on the hourly, you know, it's like one of those textbook bull flags, maybe a bull pennant, depending on how you want to draw it. They have the same outcome either way. So we have the setup, but we would need that inside day breakout to get to the upper ADR. Otherwise, break our own Globex low and we can target the lower ADR. Yep, we are between the call and the put wall, and GEX is still positive. That's absolutely right. Mentioned yesterday that it was possible for us to go continue to the upside and get to the R3 level. We didn't quite get there, but we got close to it. And it was a significant run because of how wide the pivot levels were yesterday. And of course, today's pivot levels are going to be even wider still because we had a big move yesterday. That's how it works, right? You get a big move and then they calculate a wider range. So just to kind of get a little perspective of how big the range is today compared to what it was yesterday, that's today's high, the R3, and that's the S3. So this big box all the way down to 6250 and above 6500 compared to yesterday's. I'm just going to pick one side to put this on. That's the R3 that we almost hit, and that's the low. So you can see how these floor channel pivot points change radically based on previous day's price action. If we're going to hit an R2 or an S2 today, that would be impressive to say the least. To get an R3 or an S3, nearly impossible on a day like this. So it is doable, right? We never want to say that price can't do something, but it would take a tremendous amount of news to get us to an R2 or an S2 at this point. So R1 and S1 is your focus. That'd be 63.63 and 64.28. You can see how this green area between the floor pivot and S1 is not very far, as opposed to the distance between the floor pivot and R1. And that's because the math is telling us there's more of an upside to this than there is a downside. Floor pivot calculations have directional bias in them. I know it's not really well understood or popularized, but that's the visual right there. You just have to kind of take a moment to spot it. So the directional bias of the floor pivots right now is to the upside. Just keep in mind that these pivots don't make price do anything. The same as these pivot channels. We have a wide channel today, which implies that if we break out, that the breakout doesn't stick and that we come back in again. Well, that wide channel doesn't make price break out, and it won't stop price from breaking out if we do try. It's just giving us some insight on what to expect if a breakout does occur. And what are we talking about breaking out of? It's yesterday's range. So going all the way down to yesterday's low and breaking out of it and continuing to go lower, that wide channel says it's very unlikely. Of course, it's also saying that a breakout higher from our high of yesterday and continuing to go higher is also unlikely. But these channels don't make price do anything. We are above the pivot point today, same as we were yesterday. That's bullish. We opened above it, and that's also bullish. Yesterday, we had an MDP. That's a missed daily pivot. We did not hit the pivot. And so far today, we haven't hit the pivot. The thing is, with these missed daily pivots, it only counts after the day is done, because at any point today, we could come down and then we hit it, and then it's not a missed pivot anymore. So if we go the whole day without hitting it, when we come in tomorrow, we would look back and say we have now 2 days in a row where we have a missed daily pivot. It's a part of a broader analysis that considers how strong is the current drive to the upside. A market that continues to outpace its pivot point on a day-to-day basis is really strong. You can tie that to something as simple as moving averages, or you can quantify that strength with MACD or RSI or stochastics or whatever tool it is that you like to use. But we're not getting really deep pullbacks. If we had, we would have hit the pivot. And we are continuing to exert that strength. Otherwise, we would have hit the pivot. So we'll be looking for that to end as a bit of a tell that the current drive that we're seeing is beginning to slow down. Doesn't mean, when we hit it that we're going to go down. Not going up doesn't mean going down. It just means not going up anymore. So if we get inside today's pivot channel, then the target is the pivot itself. If we can break through that, we'll aim for the channel low. And if we get through that, we'll aim for S1, level by level by level. You could also add in something like yesterday's mid. That's the RTH midpoint, 63.80. And then all of yesterday's midpoint, which, as usually happens, it lines up on some other level, happens to be the channel's low. So the entire trading range of yesterday's midpoint is that pivot channel's low. Yay. If you're looking for this indicator, by the way, Thinkorswim doesn't have this version. I made it. TradingView does. Just search for Central Pivot Range, or CPR, and you'll find their version of this floor pivot indicator with these channels on it. For mine, the YouTube replay video in the description, I have all of these charts. You can just download them there, or go to my Thinkorswim workbook on Discord and get them all for free there. I don't sell charts and indicators. It's free. All right, so we're up here. We're starting to put in the work. This isn't going to provide any insight so early on this time frame. There's just, nothing here of value. The only thing that really helps out is where's the value area on the week, 63.75, just for an easy round number. If we drop back through all this trash, then 63.75 is going to be the target. Get through that. We've got the point of control on the week, 63.50, because it still hasn't changed yet. All right, we're seeing a stronger discrepancy between the TPO and the volume profile here. This is the 10-day, 30-minute volume profile with TPO. TPO is really putting in the work over here, while the volume profile is lacking. And down at the 63.70 area, we've got a much higher volume profile, but a shallow TPO. Have no expectation that this point of control is going to move anytime soon. And when it finally does, it's very likely going to end up being that 63.70. I know it might seem like we would go to the cog line at 63.30, but that high zone is tied to the same candles that built this zone, right? So we very unlikely to go here, because when we lose these candles, we're going to lose that property too, very likely. And so we'll end up here, probably. Either way, the certainty is that the point of control is going to move up, either to the cog line at 63.32 or tighter than that and come into 63.70. What matters is where we're going to be located when it finally does get moved up there. If we stay above it, it'll continue to be like a parachute underneath us, or a catch-all if we start to fade. But if we do break below, say, Monday's high, then it's likely we're going to get stuck below Monday's high when this gets rolled up. It's still not likely to get rolled up this week. We've got to wipe out these last 2 days and then start getting into the next week's trading volume before we see this thing move. All right, we're done with that VPOC that I had marked out. By that POC, it wasn't even a VPOC. We do have a VPOC for today based on yesterday's price action. So if we get a break to the downside today, 63.92 cog line is what you're going to want to focus on. I don't set these to the tick perfect right on the line. I just get it to the nearest point. So 63.90 is close enough for me. And of course, I focus on cog lines, so 63.92 has more value than 63.90. If we break our own Globex low, watch for a first touch play across that 63.90. Remember, we don't really expect all that much out of a first touch play. 3 to 5, maybe 7 points. I know it doesn't sound like much, but 8 to 12 contracts, 4 points, it gets the job done. The weekly expected move still in focus, 64.27. Let's just round up there a little bit. When we get to that level, it's not supposed to be this concrete wall that we can't get through. So don't believe that we're just going to get there and stop on a dime. It's likely that we overshoot the level. Whether we're going to close outside of it on the week is something debatable. This thing has a history to it. These are 1 standard deviation ranges, and we're supposed to close inside that range 68 point blah, blah, blah % of the time, right? That's a 1 standard deviation calculation. And rather than counting back every single week that is shown on the chart and then running the math from that, I just simplify things. I count back 10 weeks and I ignore holiday weeks in that count, asking a very simple question. On Friday at the end of the week, did we close inside the box or not? So when you do that and you use a round number like 10, how many becomes really simple? You need 7 out of 10, right? That would give you your 70 percentile. So if I count back and I find more than 3 weeks that we closed outside of the box in these last 10 weeks, then we're not even hitting our 1 SD level. And we haven't been hitting the 1 SD level for a while. Back here, we were missing a lot. The reason it matters is on a week-to-week basis, we want to kind of have an idea of what to expect out of these levels. Markets are consistent, and if they consistently break the range, then you don't want to trust the range to hold. But then times change, right? We get into a new quarter and we get into a new market environment, different dynamics going on, and then we consistently stay inside the range. So you always want to stay on top of what are we consistently doing right now. For the past few weeks, we've been going really sideways a lot. So we calmed down after that exuberance, coming back up from the April lows and then, kind of leveling off. But make no mistake about it. Here's an example of one of those weeks where we can, get out of the box and really keep it. And on that week, the one that I just highlighted, we were outside of the box by Monday and closed outside of it by a significant amount on the very first day of the week. By the end of the week, we had continued to drive farther and farther away from the range. So when it comes to how far can we move, on the week, it can move a significant amount. Notice the prior week, we stayed in the lower half the whole week, right? We just wound up really tight, and then we had a big move. Market compression at its finest. So when it comes to these sideways markets, winding up a tight move, there's a whole week where we stayed underneath the range of Friday to the week's low. And then another couple of days where we just continued to maintain that same range. Slight breakout, and yet we didn't expand from it, really. We just got a minor breakout and then held that tight range. Now we're starting a breakout. And I bring this up because, this is a bit of a melt-up maneuver, right? Where we got up a little higher and then we held it. We could get up a little higher again and hold it again. but we could get one of those where we went sideways and then we finally break out and get one heck of a run. So if you think we're, elevated now and we're expanded now and that we've already made a big move, I think the market could, get to 66, 66 and a half, 67 and giggle about it. There wouldn't even be much effort involved. Between the flight to safety where money went home and how many funds and firms were sitting on the sidelines because of the tariffs, and there's just a lot of money on the sidelines or, rotating through treasuries and fixed income and just not speculative in the equities. That money comes home, we can expand out of this significantly. I know the bearish bias is the most popular one right now. Lots of reasons to be scared. There's a lot of bricks in the wall of worry, but markets just keep pushing higher. And until they stop doing that, participate or get out of the way. We're still safe distance from the 10. We would consider more than, say, 2% from the 10 as getting a bit extreme, and we'd be looking for a mean reversion response. But we're not even 1% away from the 10-day yet, so we're not too far away. Yesterday's move wasn't too swift. We didn't travel too far too fast, and it does not owe us any sort of mean reversion at this point. Looking at the week, we're around 4% away from the 10-week. That is a bit much, but we've been higher than that. We don't need to anticipate any sort of mean reversion from here. It will be harder to close higher from here, but that does not imply that we have to go down. We can hold the line. We can close higher on the day because the 10 is going to move towards us every day. It's moving closer, which means we can move higher and still maintain this 4%. I wouldn't expect, some big blowout move when we're this far away from the 10-week to go higher, but we can go higher. Yeah, it reminds me that's I need to make a note of that. I just had a little bit of an idea. How far is the 10 changing on a day-to-day basis? I bet we can calculate that. I'm going to see about putting that indicator together. The idea behind that thought is the market right now has an ADR of like, say, 75 points. So we can move 35 one way, 35 another, and that'd cover our 70 points, right? That's our ADR. So 35 points or 35 points lower, right? And if we did make that 35-point move and we're still 4% away from the 10-week at the end of the day, then the 10-week also has some sort of ADR, right? That it's moving on a day-to-day basis closer to us or farther away, right? If we're outrunning it, if we moved 135 points today, we would outrun the 10 even further. So we need to know how far is the 10 moving on a day-to-day basis, 10-week, by the way, and how far is price moving on a day-to-day basis. The speed of the move of the 10 will increase or decrease depending on how far away we are from it. If we got a long ways away from the 10, what would happen? The 10 would start to curl up to try to chase after us, right? As all moving averages do when you outrun them too quickly. And if we're just moving along nice and steady, then it will move along nice and steady. So we need the rate of change on the 10. I'm going to get that calculated and see what we can do with it. I think that'll help calculate our daily move. we're expecting to hold the 10 right now, maintain our distance at about 4%. We can even see it, right? That's what we've been doing, maintaining our position at about 4% away from the 10. Well, how much of a daily move do we need to get to the upside to maintain this move without increasing it too far or dropping away from it, getting too close to it again? I don't know. We'll figure out some math, all right? I like math. Nerd. Mag 7 down volume is positive. I know that's a couple of positive negative mixes together, but the Mag 7 complex has a measurement that only monitors the down volume. So when the down volume is increasing, we can see it, right? So over a 5-day period, the down volume has been elevated. This morning, the down volume is down almost 5%. So the up volume on the Mag 7 is really up. Lots of up volume on the Mag 7. And airlines are down. So when it comes to what's down this morning, gold and gold miners, airlines, consumer discretionary, oddly, and down volume of the Mag 7 complex. Looking at what's up, yeah, the dominant one. The Mag 7 up volume is up the most. Then solar, which is trash. Don't want a market led by that. Communications, that's Google's earnings. Chips, not quite. We need chips up a little bit more. This is not really a good development for one of those rally days, right? It's, if we're looking for a rally day, we need something better than that, right? Nat gas and solar technology is not what you want for an S&P NASDAQ rally. And behind that, we got pot stocks. Those three are definitely not what you want. We're looking for chips, communications, consumer discretionary technology, cloud computing, those things, not that trash. So we could break out and run higher for other reasons. It doesn't have to be the Mag 7. We could get some 0-day options flows, treasuries, bonds, dollars, FX markets could push us in the right direction. But for options, we can't see it in the pre-market, so we wouldn't know, if they're coming in yet. And for the others, I mean, we got that auction today at 1 o'clock. It's worth keeping your eye on. Otherwise, the 10 has, kind of calmed it down from those big sweeping moves that we were getting. And the dollar, these legs lower that we had talked about, has broke on that move right there, right? We had the big move, and then we had a smaller move, and then we had a smaller move. And that last one wasn't even very much of a move at all. So we could go lower from here, right? But this looks more like it has stalled out and that we're going to see the dollar try coming back up maybe into that 98 or 98.5. Hopefully not in one day, right? We don't want to make that in a single move. But if we got the dollar calming down and maybe moving back up, and we got the 10-year still holding in that range, I don't want to change that chart's time frame. We'll just look at it somewhere else. So we got the 10-year, normalizing within this range, moving back up, and the rate of change isn't extreme, then we don't have any, negative effects from the 10-year. We don't have any negative effects from the dollar. What else we got today? Right? It's not a lot left on the table. So watch the clock. Keep your eye on the headlines. Europe is still possibly a good size threat with their tariff retaliation talk. And I think that they have a rate decision that everybody seems to already know what it's going to be, but they were supposed to announce And then we have the auction at 1 o'clock. So you got the levels, you got the ranges. Look for a breakout that I don't expect to come. Right? As we got all those big things happening next week. Be careful, be safe. I'll see y'all tomorrow.